A dividend yield near 10% sounds like a gift. It is usually a warning. On July 15th, Conagra Brands, the company behind Birdseye, Slim Jim and Marie Callender's, cut its dividend in half, wrote off $2.9 billion, and guided earnings down another 16%. This is what a 100-year-old food giant hitting reset looks like, and every number in this story comes straight from the SEC filing. Start with the top line. Revenue peaked at $12.3 billion in fiscal 2023. It has fallen 3 years straight since, to $12.1 billion, $11.6 billion, and now $11.3 billion in fiscal 2026. And that last year even included an extra 53rd week worth about $200 million. So the underlying erosion is worse than the bar shows. Volumes have declined 5 straight years, and management expects a 6th. Margins are falling faster than sales. Gross margin was 27.7% in fiscal 2024. A year later, 25.9%. This year, 23.9%. Roughly 4 points of gross margin gone in 2 years. Cost inflation is running 5 to 6%. Beef, oil-linked inputs, logistics, while productivity savings top out around 4%. When costs outrun savings year after year, this is exactly what the chart looks like. Then came the write-down. $2.9 billion of non-cash goodwill and brand impairments, equal to about a third of shareholders' equity at the start of the year. The trigger, straight from the 10K, was a sustained decline in Conagra's own stock price. Birdseye, Armour, Bertolli, Wishbone, all written down. And here is the kicker. The frozen unit that took the hit is now carried at fair value with zero cushion. Any further slip risks, yet another impairment. That write-down split the earnings picture in two. Reported results, a loss of $4 per share. Adjusted, backing out the non-cash charges, $1.72 of earnings. Both are true. Adjusted tells you the run rate economics, reported tells you what happened to book value. But the number that stung was the guide. Fiscal 2027 adjusted earnings per share of just $1.40 to $1.50. That is down another 16% at the midpoint and below what analysts were expecting. And so, the dividend. Cut in half, from $1.40 to 70 cents a year. At the old rate, Conagra was paying out $670 million a year, most of its free cash flow. The new rate frees roughly $335 million annually, about $1 billion over 3 years, and puts the payout right at the company's own 50% target. The market had priced this for months. A 10% yield was never real income. Why cut? The balance sheet. Net debt is $7.1 billion, almost exactly the market value of the entire company. Leverage sits at 3.8 times adjusted earnings before interest, taxes, depreciation, and amortization. And here is the surprise. It is guided to rise to about 4 times next year before it gets better, because earnings are falling faster than debt. $762 million of notes come due this October. The dividend cut is not strategy, it is oxygen. Under the hood, the 4 segments tell very different stories. Grocery and snacks is the profit engine, with a 19% adjusted operating margin. But refrigerated and frozen, the strategic core, the Birdseye and Marie Callender's business, earned just 10.5%, down 3.5 points, and it absorbed the entire goodwill write-down. That is exactly where new chief executive John Brase is raising prices and pouring in brand investment. The turnaround lives or dies in the frozen aisle. So, what is it worth? At around $14, the stock trades at under 10 times forward earnings with a 14% trailing free cash flow yield. We ran a discounted cash flow 3 ways. The base case, the plan works as guided, lands almost exactly at today's price. The bull case, where margins rebuild, points to the low 20s. The bear case, where pricing fails, is brutal. The $7 billion debt stack swallows nearly all the enterprise value, leaving the equity worth very little. Applying peer multiples like General Mills implies $15 to $18. These are implied values under stated assumptions, not price targets. The new playbook has 4 moves. Raise frozen prices starting mid-second quarter. Boost advertising 14%. Step capital spending up to $550 million, including roughly $100 million to bring fried chicken production in-house. And attack a portfolio of 5,500 SKUs for simplification. The full strategy, including possible portfolio sales, arrives at an investor day in early 2027. Until then, watch elasticity. If shoppers walk away from higher frozen prices, the whole plan unwinds. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description. Here is the bottom line. Fiscal 2026 was the year Conagra stopped defending the old story. The dividend is now covered. The goodwill now reflects reality. And guidance assumes the consumer stays tough. At $14, this is a leveraged bet on one specific plan. Pricing holds, margins stabilize, leverage peaks and turns down. Watch the October refinancing and that early 2027 investor day. If the plan holds, the math points higher. If it slips, the debt, not the dividend, becomes the story. This is not investment advice, but now you know exactly what to watch. Subscribe for more filings first analysis.